Did you know that nearly 1 in 3 Australian mortgage holders are currently at risk of mortgage stress? That's around 1.47 million people. But here's where many people get it wrong. Mortgage stress and mortgage default aren't the same thing. About 28% are stressed, less than 2% are actually in default. In fact, you can be under severe mortgage stress and still never default on your home loan, although the risk does increase if you're under mortgage stress. But when people treat these as the same thing, decisions often come from fear rather than information. Some people panic and make rushed financial decisions they later regret. So, what's the difference and why does it even matter? Let's break it down. Welcome back to the channel. If you're new here, my name is Novah. I've spent over 15 years in banking as a credit risk professional, and here I just break down personal debt and lending through a risk lens. And if that's useful to you, consider subscribing and like each video that makes a difference to you. Everything I share here is for general financial education only and is not meant for personal financial advice. And today we are unpacking a topic that affects thousands of households, the difference between mortgage stress and mortgage default, and why understanding it early can make a significant difference. Let's start with mortgage stress. Mortgage stress generally refers to a situation where a household is finding it difficult to comfortably meet mortgage repayments while also covering other living expenses. You may still be making every mortgage repayment on time. However, you might be facing different scenarios. For example, you are using savings to cover everyday expenses, hence having little or no emergency savings, constantly living from payday to payday, missing utility bill payments or unsecured loan repayments just to keep up with your mortgage repayments, heavily relying on credit cards to cover basic essentials. And the word here is over-reliance, not normal usage of credit cards. Or you could just be working additional jobs just to stay afloat. You could also be feeling anxious whenever a repayment date approaches. There are those who may be using one form of credit to pay another, like using credit card balance or overdraft facilities to repay their mortgages. In other words, mortgage stress is often a warning sign. The loan is still performing, but the household budget is under pressure. Think of mortgage stress as the financial equivalent of a warning light appearing on your dashboard. The car is still running, but it may need attention. So, several factors have contributed to rising mortgage stress in recent years, starting from higher interest rates, increased grocery costs, rising insurance premiums, higher utility bills, increased rent and housing costs, just general increase of the cost of living pressures. Many households that comfortably managed repayments a few years ago are now finding their budgets much tighter. The challenge isn't always a single large expense. Often it's the combination of many smaller increases occurring at the same time. And here is an example I just want to share. Imagine Sarah has a mortgage repayment of $3,200 per month. She hasn't missed a payment yet. However, she has stopped contributing to her savings, increased her credit card balance, unable to make her bill payments, and regularly uses BNPL services to manage her cash flow. Sarah is experiencing mortgage stress, but she hasn't defaulted on her mortgage repayments. And so now, what is mortgage default? Mortgage default is a much more serious stage. Unlike mortgage stress, default is no longer a warning sign. A mortgage default generally occurs when a borrower fails to meet the terms of their loan agreement. This often happens when repayments are missed and remain unpaid. The exact process can vary between lenders, but generally you find that a repayment is missed, the account falls into arrears, the lender contacts the borrower, hardship assistance may be offered, but if the situation remains unresolved, the account can move towards default. Default is not simply financial pressure. It involves an actual breach of the loan contract. At this point, the lender's focus shifts from prevention to risk management and recovery. Mortgage stress versus default. What's the key difference? The easiest way to think about it is this. Mortgage stress is a warning sign. Mortgage default is an event. Mortgage stress says, I am struggling. Mortgage default says, I have failed to meet the loan obligations. One happens before the other. Not everyone experiencing mortgage stress will default on their loan, but many mortgage defaults begin with unmanaged mortgage stress. So, what can you do if you're experiencing mortgage stress? If you're feeling mortgage stress, the most important thing is not to ignore it. Some practical steps include reviewing your household budget, identifying discretionary spending, seeking financial counseling if required, contacting your lender early if repayments are becoming difficult. One of the biggest misconceptions is that lenders want borrowers to fail. In reality, most lenders would prefer to help customers get back on track before things become serious. And if you're experiencing mortgage stress, don't wait until you've missed multiple repayments. When you contact your lender, they will review your request based on the rationale you've provided to them. And some of the commonly known options may include temporary repayment reductions, payment pauses, commonly called loan deferrals, loan restructures, interest-only arrangements, among other things like allowing you time to sell an asset. And just know that support options is on case-by-case basis. Lenders will review and decide what is suitable, sustainable, and makes sense for your situation. Approval is on case-by-case basis and not automatic. To know how it reflects on your credit report, check my earlier video on credit report or Credit Smart website, which is an authorized website for public use, and it has a lot of details there. And the earlier the conversation happens, the lesser the impact may be. And more options are usually available. Once an account becomes severely delinquent, the available solutions may become more limited, but options are still there. One of the most common mistakes people make is avoiding communication. They stop answering calls. They ignore letters. They assume things will somehow improve. Unfortunately, lenders generally interpret silence as lack of engagement. Even if you can't make the full repayment, maintaining communication can make a significant difference. The earlier action is taken, the better the chance of finding a workable solution. And as I conclude, I just want to say that mortgage stress means you are struggling financially, but may still be meeting your repayments. Mortgage default means that you have failed to meet your loan obligations, and the lender may begin more serious recovery actions. But the good news is that mortgage stress is often an opportunity to take action before things become more serious. If you found this video helpful, please like and subscribe if you haven't already, and share it with someone who may be worried about their mortgage but isn't sure what the warning signs look like. And in the next video, we'll explore how financial hardship applications really work and what lenders look for when assessing them. That is a video worth watching before you ever need to make that call. Thank you.